Hey everyone, I've got to do one thing on my computer and then I'll start talking. Sorry about that everyone, one thing I had to fix. So I'm good on trade session now. One second here. There we go. So first bar we gapped up, and I'll do a quick review of the daily chart because I want to talk about what you should look for on the open. We've had a tight trading range right here, and it's possible this is an inside day, but with the FOMC report, it's probably gonna, we could easily break to the upside. Now, I'll talk more about the higher time frames momentarily, but what I really want to focus on is how to trade the open. So right now, if I'm looking at this, the first thing I'm thinking about is always in long, always in short. We gapped up. Bar one's a bear bar, bar two's a bull bar. If bar two closes on its high, it's probably always in long. However, the bulls are going to need consecutive bull bars. So for me, if this bar closes on its high and the next bar is a follow through, it's a buy the close bar for at least a second leg up. Now, let me just, and I gotta add to update one thing in my TradeStation account. Looks like it's all good now. There we go. So there's two things I'm thinking about when trading the open. The first is the trading range open. The next is a trend from the open. We have a gap up and bad follow through bar one. To me, there's sellers above bar one. So if I'm doing anything here, I'm selling bar one, scaling in higher, looking for a scalp. The problem with that is I know the range is going to double. Therefore, it's kind of like buying after buying a pullback of two or a pullback of three. Now, this is different because it's a micro channel, but there's the added risk on the open that you're going to get a breakout up or down. I'm going to move this up here as a mental reminder that the FOMC is today. So most people on the open need to be patient. It's really easy to get trapped and take a bad trade. And because the bars are typically big on the open, for one, I wouldn't do anything with bar two, but because the bars can typically be big on the open, it's very easy to make a mistake, take a big loss, and not recover from it, and not be able to recover from it before the end of the day. So what am I doing here? I've done nothing. And while I typically am resistant to doing much on the open other than buying a bull close or selling a bear close, and I need consecutive strong bull closes or strong bear closes before doing anything. It might be always in long if this bar closes on its high. This tail makes me hesitant. So let me do this. Let's go to a 5-minute chart of, I just want to scroll through a couple of days for just a second. So this is, I try and keep the open really simple. That's going to throw me off. So when I'm looking at the open, let's just go to a random time period. Type trading range, wait for a bear breakout, follow through, sell the close. And go to this day right here. So here's the first bar. Bear breakout, follow through, but in a micro channel, you can sell the close, but probably better to wait for more. If I had to do anything, it's sell the close, stop up here. Now, when you get a lot of dojis on the open, if I'm selling, I want strong follow through because I know there's a pretty good chance that the market will reverse. So let me go over here. Bear bar or doji bar. Don't do anything. Don't do anything. Nothing. Break it. Follow through. If I do anything, it's sell to close. Now, I am a little resistant with this much climactic behavior because the market's probably going to go sideways. But the only choice is to sell. But that's the problem with the open. When you get a lot of climactic behavior, better to wait. So here, this is setting up for a buy the close bar. And you keep it pretty simple. If you can, the problem is 77 to 53 at a minimum stop below 2. So if this bar closes on the high, you're risking 20 points. Notice what's going on right here. The market is selling off, and that means that bears who sold too high and scaled them higher are able to make money. That is not ideal for the bulls. So this is why it's important to wait for a strong bull close. For me, if I had to do anything, it's like what I said above bar 1. I think there's sellers above 1, and I think there's sellers above 2. I would rather wait for consecutive strong closes to buy or wait for more information. I'm less willing to sell above bars on the open. I'm less willing to fade on the open because it's easy to get trapped. And I'd rather look for swing trade. Consecutive bear bars, sell to close for second leg. Testing the open of the week. And we have to think about the market probably going sideways for a lot today. And because it's an FOMC day. And it's common for the FOMC to go sideways for most of the day and then have a breakout up or down. So here you go. Now the market's setting up. It's kind of an implied 2 legs up, but it's a 3-bar micro channel. So far, if you're trading always in, which most people should, there's no buy yet. No reason to buy above 1, no reason to buy above 2, or buy the close of 2. Therefore, the only choice is to sell. Now is to look to sell below bar 3. Therefore, what some traders can do is, if I was going to take this trade, it's reasonable to here, 61. If this bar closes on its low, it's reasonable to sell below it. So there's one. Let me check one thing for a second. This is a simulated account. I just want to make sure it is because so most traders can sell below this bar, stop above the high of the bar, 78, 75. So basically that's here. And one of the reasons why it's important so I'll keep that in there for the moment, but one of the reasons why a lot of traders like to sell below the bar instead of just selling the close is if you're selling below the bar, and this is a swing trade, if you're selling below the bar, I want the bar to stop me into the trade because it's possible it does not trigger. Now, if I'm taking this is an aggressive sell on the open, and the bar is rather big. So if this bar triggers, I want the market to go my way rather quickly. Otherwise, I'd rather just get out of the trade. So one thing I'll do is perhaps put a stop. I did not mean to do that. Computer's lagging a little bit. But if this doesn't brace down pretty quick, I'm more hesitant to just exit. But we'll give it just a second. So why sell below bar 3? It's a swing trade. You're taking the sell below bar 3 betting that the market is going to have at least a small second leg down and go sideways. Now, so far, I do not like the follow-through of this bar. Now, so far, I do not like the follow-through of this bar. And if it doesn't start to race down pretty quick, I'll be quick to exit. The other choice for always in trading is you wait for consecutive strong trend bars. So for some traders, they'd be disappointed enough where they may just exit as the market goes right back down. Other traders would wait and say they'd rather wait to see what this bar looks like. It depends on personality. If you don't want to lose as much, you may say that the market is not selling off. I'd rather get out quickly. If you want to keep the management simple, you wait and see what this bar closes as. If this bar does not go down into the close, I'll be pretty quick to exit. So, a little bit of a lag. Trying to sell off into the close. Now, since I'm in this trade and I'm thinking aloud, am I glad it's going down? At least selling off somewhere to the close? Yes. But I'm overall disappointed about this position. Not doing what I want it to do. Therefore, the stop is up here. However, if the market starts to turn down, I may be tempted to look to try and exit break even. For the bulls, they can call it a second entry, but above the doji, the bulls probably need consecutive bull bars. They need this bar to close on its high to convince a lot of traders to give up. Otherwise, traders would expect probably a second leg down. So here, I'm disappointed enough that I'll probably just look to scalp out somewhere around down here. So maybe the low of bar 1. So 56. I'll just move it arbitrarily right there. And my thought on that is I don't think bar 1 or bar 4 is the low of the day. Just one moment. I'm having to manage another position I'm in. So I'll come back to that in a second. So for the bears, I think this breakout's strong enough for a second leg. And the market's deciding, these bears are deciding, are they trying to get out at the low of bar 3? And they're deciding if is 4 disappointing enough that those traders want to get out, or are they saying that 3 is strong enough that it's stronger than 4 and the market's going to go a little bit lower? I think the market's going to try and go a little bit lower. But I'm already disappointed with 4. Why did 3, for always in bears that sold below 3, why didn't 4 race down? Why isn't 4 a strong entry bar? And the reason it's not a strong entry bar is it's telling everybody that the market's in a trading range. If it's in a trading range, I want to be very careful about trading with stops. Now, in my other account, I sold a little bit of a pullback, basically a couple ticks, couple points higher than this close of 3, and I sold more above bar 4, and I got out part around my first entry. So all it did was it basically raised my entry price on the trade, where I can get out more at break even. I still think the market's going to go a little bit lower, but I need to see, for the bears, I need to see signs of strength here. I don't want to see a second bull bar closing on its high. So far, we're 4 minutes into the trade, and the bears are not doing anything. And when this bar closes, if it closes right here, it'll be 10 minutes since bar 3 formed, and the bears have failed to do something. That is disappointing, and disappointment is a hallmark of a trading range. You have to ask yourself, for the bulls, bar 4 is not strong, and it's following bar 3. But for the bears, bar 3 is big, but 4 and 5 so far are bad follow-through bars. So overall, confusing picture. This is making me suspect that the market is going to go more sideways. Overall, confusing picture. This is making me suspect that the market is going to go more sideways. You can see bears trying to get out break even at the low of 3 and the low of bar 5. For the bulls, let's see if the bulls can get, they got a breakout above bar 4. Let's see if bar 6 can close above bar 5. So trending bars, low, higher low, high above this high. But the bulls need to get signs of strength. They have a close and then a higher close. They need to get a bar closing above this bar. Otherwise, the market's probably going to go more sideways. So confusing picture. Bear bar, then a big bull bar. Bear bar, and then bull bars. Why am I getting out? I set a limit order out to break even. In part, if I'm trading this environment, I really want to scale in and use limit orders. And this is not doing what I anticipated. So if you are trading always in, technically if you were trading always in and you had to be in the market, your stop's up here and you hold. But for me, I do think we're going lower, but it's really hard for me to, when I'm disappointed, I want out of trades. And that is just because I like high probability trades. And if this bar closes on a high, I'll just exit the trade. So the bulls are trying hard to reverse the bears here. You have other bulls who bought the close of 2, disappointed 3, trying to get out around break even here. The bulls want a double bottom with 1 and 4 and an upside breakout and a test of the open of the week. The bears want basically 2 legs up and a failed breakout above bar 2 and a second leg down. So important bar right here. Can the bulls get a bull bar closing on their high, convincing more bears to possibly exit? Or can the bears get a doji bar here? Or preferably, can the bears get another bar closing on its low, increasing the odds of a second leg down? The other thing about always in is the more confident one becomes in their ability to re-enter the trade, then the quicker people become to get out. So in other words, that's why I think it's so important to be able to trade small, is if you can trade really small, it's easier to be able to exit trades and just re-enter because you're never worried about the risk. I can sell here, take profits on the way down, I can sell again, take profits on the way down. You can buy all the way up here, you can buy this close, take profits on the way up. So far, it doesn't look like the bears are doing what they need to do. Still about 50 seconds left in this bar. So let's see how this bar closes. Bulls are trying hard to get a close above bar 5. It was a little weird. Let me check something actually. I want to see if there's a lag. I can't tell if I actually got out of the trade or at first I thought I accidentally hit the close button here, but I'm on a wireless mouse and I don't like to use touchpads when I trade because it's too easy to tap the button accidentally. So let me see. Give me just one moment. I'm curious to see if I was taken out of the trade or not. Big bar, but after 3 consecutive bull bars, I'm a disappointed bear. And because of that, I want to wait for more information. So it looks like I checked, and again, this is a simulated account. It looks like this went down fast enough where it let me out. And that was pretty lucky because I was probably just going to exit the trade right there. So what would I do here at the bull? Well, look what happened on this current bar. After 3 consecutive bull bars, bears are disappointed. So another thing to point out is bar 1, there's a few things I would write down. I think they're really important probabilities. One is bar 1 is 20% of the time, it's the lower the time of the day. So basically how you should write that off is bar 1 is almost never going to be the high or low of the day. And typically when it is the high or low of the day, it will typically be the high or low of the day. Let me go back here for a minute. It'll typically be the high or low of the day when the market is trending. So it's reasonable for always in traders to buy above bar 6. However, lots of trading range price action. So there should be almost sirens going off in your head about this is the trading range. There should be almost sirens going off in your head about this is the trading range. So that's why some traders will buy real quick. But you can see the market went below 1 and reversed up. Okay, so this is important why it's a good idea to typically wait for the bar to close. You can easily get trapped here. So what do you do here? Well, for some traders, what I like to do if I'm trading always in is you can look at this bar and say, I'll sell the close right here. It's always in short, probably going lower. I want to sell a pullback though, because if the bar starts to turn up, I can exit the trade rather quickly. And I want to see the market race down. So a logical target, maybe yesterday's close, 42.44. And I try to be stupid about it. I say, big bear bar, it's probably going lower, sell the close. And if this bar turns up, this bar closes as a bull bar, closing on its high, maybe it's 2 legs down, who cares? I'll just get out of the trade and look to sell lower. Now, the bar is big, so you have to be able to trade small. It's not doing what I want exactly, so I'm just going to get out of the trade for, I think that was 8 points profit. So why did I do that? Why did I exit the trade? Well, again, I'm confident. So the longer you trade, the easier it is to enter and exit. I'm confident in my ability to just re-enter the trade if this is bear bar closing on its low. Otherwise, always in short, stop above, sell the close, and you wait for a reversal. But for me, my problem with staying short on this bar is it's a big bar. And I know there's buyers buying this bar, betting on it failing. I just know that. Just look at really big bars and look at the follow through. The follow through is usually not that great. So we have a lot of trading range price action. We're testing the close. And to me, this is big risk. So from a risk reward standpoint, if I'm selling this bar, stop up here, that's my 1 times my risk. I know that's a bad trade. So the only way I can take that is if I manage the trade well. But for me, the easy answer is the only thing I can do here is short. I don't want to buy for any reason. I'm okay with exiting a sell and looking to sell again. but it's always in short, so it's the only thing I want to focus on. Double top. It's also kind of an expanding triangle. 1, 2, 3, 1, 2. Not great shape, but have to think about that. The bears, they see a breakout below this neckline. They want to measure and move down. So what do you do if this bar closes down here? Well, consecutive bear bars. What have I talked about when trading the open? Look for consecutive trend bars. And if you get consecutive trend bars, just sell the close. Sell the close, use a wide stop, better on the second leg down. It's better if you can use a wider stop. And I'm also resistant to holding trades for that long. I like quick trades. I like trades that are, I like to sell, I like to scale in, I like to scale out. So, and I think that's just the longer you trade, the more someone becomes that way. So for me, this bar closes down here. I just sell the close, wide stop. And do I care that the market, that I gave up a little bit of profit by getting out early here? No. I don't care one bit. And the reason I don't care is I'll just sell again. Who cares? So what are the chances that this is some sort of second leg trap, or that this is a big bear bar and the next bar is a big bull bar? It's possible, but low probability. Other traders, some bulls buy it here, this close, and they'll be disappointed by the follow through here, and they'll try and get out break even back at the 7 close. That means that some bears that are limit order scalpers try and sell at the 7 close. So it's a follow through bar. For me, you can sell the close. I'd rather sell a pullback. And if I miss the trade, who cares? The reason I want to sell the pullback is I think we're going up to here. So for me, I'll just sell, 49 even, let's just say. I'll do 48.50. The key with trading is to realize you can always enter later. You do not have to, I think that's a really important thing to realize is you have to be okay with missing things. You're going to miss trades. You're going to pick a bad entry, and that's okay. That happens all the time. The key is quality of trades, but it's always in short, stop up here. So if you had to do anything, just sell. For me, I'm less resistant because it's a very big bar follow through, but the tail's big. So I think there's going to be a pullback relatively soon, at least a couple points. But it's okay to sell here. Now, one thing I'll often do, here I'm trying to just trade one position. I'll deal with that in a second. But one thing I'll do is maybe trade really small, trade a fourth size position on this close, like bar 8, sell the close, wide stop, and sell more higher. I do that pretty frequently. And I would have done that here, but I've been talking just now. And I took one trip. So all I've done in my actual account is basically sold this close or sold a pullback, scaled it higher, got out part here, and then the other part I got out, I guess, during this bars and went down. I had a target somewhere down here. So not really that much in terms of points, but my goal, at least for my personal trading, is I want high probability. That is my number one goal. I don't like low probability trades, and I'll take them sometimes, but they're not my favorite. I don't think that's how most traders should trade. Most traders should focus on some form of reasonably tight stops, not worry about scaling in, and always in trading. Because if they can understand always in trading, and that is basically finding major and finding reversal points. If they can understand that concept always in trading, then they can piece together how to scalp. Most people focus too much on scalping, and what that does is it forces them to, they will screw it up because they don't understand how the swing trading works. They'll end up buying below bar 4 during bar 7 and then not realize it's always in short of this bar. So instead of exiting, they will scale in lower. And typically that works most of the time. You can buy the low of 4, scale in here, buy more here, get out, break even. That works a lot. However, the one time it doesn't work, you buy the low of 1, scale in lower, and you end up exiting at the low of 10, or you exit all the way down here. And that is just not, obviously that's not how you should trade it. So what am I doing here? Well, I'm looking to sell, and I'll probably sell above a bear bar. That's kind of my next method. That does seem catastrophic, and price actionable. The reason I bring that up is I think everyone should try this. Try it on simulated. Please don't do it with real money because it's just not a good idea. But it can teach you something. And what it teaches you is what I would try is just pick a bar. So buy below the bar 6 and just scale in, 3 or 4 points lower 5 or 6 times. One contract, another contract, another contract, another contract, another contract, and just see how many times the market lets you get out break even. Now, that is not how most people should trade. So why am I recommending to do that? Well, the reason I'm recommending to do that is what it teaches you is one thing. It teaches you that most of the time scaling traders can avoid a loss. What that means is most of the time breakouts do this. There's something wrong with the breakouts. And I'll talk more about that in a second. So here, I don't want to sell down here because of the tail. So one thing I might consider doing is I'm going to say, I know bulls are trapped at the 7 close. They bought the close of 7, scaled in more below 8 or 9. What are they going to do at the 7 close or the 7 low? Well, they're probably going to sell out of longs. So if they're going to sell out of longs, I want to sell into a short where they're selling out of longs. So it's still always in short, probably going to get a second leg down for me since I like limit order trading and scalping. I like to try and maximize, get a better entry. But you'll notice, yeah, exactly. Look right here. What would you do if you bought the 7 close and you bought more below 8? You're going to say, this isn't what I wanted. I wanted to buy the 7 close and I wanted the next bar to reverse up and give me a profit. I didn't want the market to simply go straight down. It's the same thing as, we're trying to find a good example. It's what I talked about over here. Bulls, they bought the 18 low and they got trapped. What are they going to do when the price gets back to 18? It's going to become resistance. Did you see something? So I'm in the trade. Now, how would I manage this? Well, obviously, I'm just going to put a stop in somewhere. So I'll just move it up, out of the way. And I want to see how this bar closes. If it's a bull bar closing on a high, maybe I exit. Otherwise, I'll just say, okay, I'll put my stop. I'll set a target somewhere down here. And I want to see what this bar does. So I'm betting that this bar does not close on its high. After this much selling pressure, probably more sideways. Now, if I'm taking this trade, I'm typically willing to scale in. But bar 7, bar 9, is probably not an ideal buy after this much selling pressure. So probably going at least a little bit sideways. So pay attention to the 7 close here. Let's see what happens. So typically in this case, if I sold here, I would sell more. Give me 1 second. I have to manage something else that I'm doing. So if I'm willing to sell 7 close, I'm going to sell more above here. And that's what I want to see. I want to see the bulls start to give up, or at least scalp out of the trade. So I just put an arbitrary target basically back at the 8 low. I do think we're going below 9. However, I think we may get 2 legs up, so I just want to get out of the trade for a quick profit and move on to the next one. You know, I'm not so concerned about, I'm not always that interested in maximizing the distance of the trade. I'm more interested in taking a reasonable trade and moving on to something else. So if this bar closes as a doji, maybe that's buying back short at the low of this bar. One second. Now this is a trade I did take in my personal account. I just kind of sold at the market as this bar went up. But I'm willing to sell more above this bar here, and my stop is somewhere up here, so it's a wide stop. Now, obviously, the risk reward is bad on that trade, and there's no way I'm going to let that stop get hit. I mean, the only way I would let it get hit is if the market just somehow, just like this, just raced up instantly, stopping out, or if there was some kind of, you know, who knows, the internet stopped working or something. If you're trading with wide stops and your risk reward's bad, you have to, when you have high probability, you have bad risk reward. And what that means is you have to have a way to exit the trade rather quickly. So in this case, what I'm going to do is I'll look to sell more up here, let's just say 54 even. And since this is a bad low 1 on 10, I'm going to buy, I want to buy back a short a little above that low 1 and just move on to another trade. But for me, it's always in short, yes. So you can be short. However, the problem I have with the market is this to me looks overall like a trading range. And if it looks like a trading range, I want to be careful about swing trading. It's possible that the market has to test back up here where the bulls originally got trapped and allow those bulls out at break even. So when I'm scalping, I typically try and favor the always in direction. So this is probably reset the count to leg 1. Yeah, I'll explain in just a second why bar 10 is a bad low 1. This is a strong enough breakout to probably reset the count. Therefore, it increases the odds that the market will at least probably go sideways. Why would I exit right around the 10 low? Well, if the market falls below 10, it's a bad low 1 because it's a stop entry below bar 10. Just ask yourself. The one thing I do is when I'm in a trade, I always ask myself, would I enter this trade at that entry price? So in other words, if I'm short here, am I willing to short below 10? So in other words, if I'm flat and I have to get in the market, am I going to sell below 10? No, I'm not willing to sell below 10 because it's a doji, it's a bull bar, not a doji, closing above its midpoint, and there's too much risk of a second leg. It's a dumb sell to me. You know, why would I do that when I think the market's going to go higher? Therefore, I want to look to find a way to exit the trade around then. I could also say that 8 is a disappointing sell to close bar. So traders sold to close of 8, disappointed 9 and 10. What are they doing back at the 8 close? See that tail right there? Let me zoom in. Notice the close right here, and notice why we're starting to stall. The market's deciding some of these bears that sold this close and scaled in are getting out back at the 8 close. So it's okay to be short. It's okay to sell and hold for a couple legs down. My issue is I think there's too much risk. We have to go back up here. And as I said earlier, I like to make a quick profit and move on to another trade. I think to me that suits my personality. So it's not doing exactly what I want to do. So now I'm going to think about getting out at 46, which is basically the low close here. I'll just get out right there at 44, and you can see, okay, I just got filled. So, and it still went to low right here. Now, that doesn't mean I'm necessarily willing to, would I buy the low of 10? I think you can. My concern with buying the low of 10, though, is you probably will get at least a small second leg down. And in general, that is a more challenging trade. I really recommend most traders stay in the direction of always in, because if I'm selling, it's easy. My stop goes somewhere up here. If I'm buying, that's not so simple. If I buy the low of 10 and put a stop below 9, well, do I really want to get stopped out below 9? No. So that's why I wanted to buy back short before the low of 10, because there's probably buyers below there. Now, I don't know if I was, and even the same for my personal account. I got out somewhere. I basically took the same trade in my personal account, willing to scale in. And, I would probably be willing to buy the low of 10 if I was flat. But since I've been short, I'm in short mode, and I don't want to just quickly switch to buying mode. That's another thing. If you like basketball, I like to think of, or even baseball. Al always talked about baseball in the room. And he said the key to trading is to hit a lot of singles. I kind of equate that to, I like basketball. And I always equate that to make a layup, make a free throw. Be really good at the simple things, and that will take you a far ways. Don't worry about the exotic trades or doing something crazy. Just keep it simple. And like I said earlier, you can be short, stop above 9 and hold. And the reality is it's probably going down here. So am I going to look and say, darn, I was just short here. Am I going to beat myself up for the market going further? No. I'm going to say, thanks for the little profit I got. I'm going to move on to another trade. Who cares? I always liked when I would call it little bags of money, where you can, he would take his profit and move on. And really good traders do that. If you look at, for those of you in Orlando that got to listen to Ali talk, Ali is really big on, he has the scouts, he has his profit target. He does not care that the market goes down another 40 points from where he entered. He's interested in his target, his profit, and moving on to the next trade. So always in short, yes. 10 and 11, it's basically forming a low one short. I think we're going to get a second leg down here. So you can be short. You can see the bulls. Do you see what happened here? The bulls that bought the 10 low scalped out as the market went up. And a lot of those traders were only interested in 3 or 4 point scalp. That's why the market turned down. Bears know that. So if I'm a bear and I know the bulls are going to buy at the 10 low, why would I sell the 10 low? It would make more sense to try and sell where those bulls are exiting. So limit order trading, a lot of limit order trading is entering where traders are going to become disappointed and scalp out. It's the same thing as bar 10, bar 9 is a terrible looking bar to buy the close. And I said it's not ideal, but I said bulls would buy the close. Well, think about this. What if I'm a bull and I say, okay, I know bears are going to buy the close, sell the close of this bar. However, it's probably not going to go a measure move down. So maybe I'll do this. I'll look at this bar and I'll say, okay, the stop is from here to here. This is 1 times the risk. I'll try and buy a little bit above 50% of their target. So I'll try and buy somewhere down here. Or another way to say that is, if you sold the close, maybe you'll go for a 10-point target. I'll buy 10 points lower. And you can see bulls bought and they made a profit. So the other thing I would say is think about one directional moves. That is kind of there's probably a better way to explain it, but the market moves in directional probability. what's the probability the market's going to go 1 point higher or 1 point lower, 5 points higher or 5 points lower, 20 points higher or 20 points lower. So the reality is, if you think about this range, what's the probability that the market's going to go here? What's the probability the market's going to go all the way down to here before it goes to here? Well, I think the market's going to go up to here. That's why I don't want to swing trade and hold short. And my comment earlier about scaling in, traders will buy the 6 low and just scaling all the way down. I don't think you shouldn't do that. I'm not recommending it. But the reason I bring that up is it can help teach you. That's one thing that really taught me that most of the time scaling traders make money. And if most of the time they make money, then that means most breakouts don't go that far. A lot of traders, you have to think like an institution. If you really want to become consistently profitable in trading, you have to realize that, and by the way, always in traders, what I do, I don't know, if this bar closes on a tie, I'd exit. Too much risk for going back to the one low and somewhere up here. So, it's a reasonable buy. If would I take that buy? I think it's okay, but I want to talk for a second, and I took a short up here. Sometimes when I see a big bar like this, I'll try and buy a pullback, and I want the market to race up rather quickly, and if it doesn't, I exit the trade. So what I'm betting on is basically saying, if I'm buying right here, if the market doesn't reverse up quickly, I'll exit for a small profit or small loss. If it closes on the flow, I'll just get out. But I'm hoping that, when I'm doing that, I'm betting that the market is forming a pullback. Give me just a second. Give me a second. I'll talk about what I was talking about earlier about scaling in. I took kind of a dumb trade. I bought this pullback, and maybe it'll work out. I basically bought more lower, got out break even on the entire trade. And in part, I'm talking here. And whenever I do something and I don't like it, I think maybe I screwed up, I just get out. In this case, it turned out to be a good trade, but I'm talking and I want to be careful. That's another thing. I'm pretty protective of, I try and protect profits. I want to protect what I've made, and I know that if I can make a lot of little layups, then that goes a long way down the road. But the point about scaling in is, if you realize that most of the time the market will reverse, most of the time the breakouts don't go that far, what you start to learn is every time you if you sell during the first leg and scale in, you're almost always going to have a second leg down. So part of the reason why I'm resistant here is this is strong enough probably to have a second leg down. Therefore, I know that if a trader sells and scales in, they're probably going to make money. That's why I thought that was kind of a dumb trade, so I got out. And when you have a third leg up, for example, leg 1, pullback, leg 2, pullback, maybe this is leg 3. Leg 3 often fails. So I would challenge you guys, take an experiment with, and don't do it live, but with a simulated account, start to realize how often scaling traders make money fading breakouts. And it'll teach you that most breakouts truly fail. So what do we have here? Well, bar 12, the close of the 60-minute bar. What happened to our really strong looking breakout? Well, it's a terrible looking breakout in a very tight trading range. So it's triangle. 1, 2, 3, 1, 2, 3, something like that. So if I had to do anything, what would I do? Tough call. I think it's reasonable. You're starting to get a micro channel, lots of tails below bars. So some traders, they will buy, maybe they'll buy the 13 low, betting on the second leg up. So if I do anything, I don't know. For me, I'm more interested in waiting here. I think we're going to pull back and allow these traders to outbreak even. So I think we have to get to the one low. I mean, we don't have to get there, but we probably will. And you can see what happened on 8. Bulls bought the one low during 9, during 7. 8 came really close to it. So probably going to get back to it. This might be a bear flag, but trading range day, don't be at all surprised if we get an upside breakout of a bear flag. Trading ranges love to get bull breakouts of bear flags and bear breakouts of bull flags. Happens all the time. So always be cautious. That's why I'm always real cautious and kind of nervous, if you will, pessimistic of selling low in what could be a trading range. I really don't like to do it because most of the time it doesn't go too well. Now, let's talk about trading the open. Another thing, we've had a pretty big sell-off on 7 and 8. So what's the probability that we're going to get a strong bull trend? In other words, what's the probability that we get, and I'll pull up some encyclopedia slides in a second. What's the probability that we're going to do this and go up to here? Well, it's pretty low. Whenever you get strong selling on the open, it's a pretty safe bet to assume that the market's going to be a bear trend or trading range. Now, if it's a trading range, we could go all the way up to the highs and go sideways. But the reality is, traders that sell, use a really wide stop, are probably going to make money. So it's dangerous to look to buy too high. For me, I want to sell because I think we'll get a second leg down, but I don't want to sell this. So, I don't know. Maybe if this bar closes on its low, but it would still be a 4 or 5 bar micro channel. So is bar 12 a failed high 2, someone asked. Well, yeah, I mean, a high 2, whenever you have a high 2 in a bear move, it always fails, forms a low 2. You can call it that, you can call it wedge. High 1, so there's a low 1. High 2, here's a low 2. 1, 2, 3, could be a wedge top. So, sure. The problem with what concerns me here for the bulls is this right here. You have a pretty big bear bar and terrible looking follow through. So the bears will probably get a second leg down. But if I'm a bull, just ask yourself, if I'm a bull and I'm buy here and I use a crazy wide stop down here, if I buy above this bar and buy more lower, am I going to lose money? Probably not. I'm probably going to make money. Now, this is a bad buy though as well, because strong enough that it's probably going to go at least have a second leg down. Wrong. There we go. So, probably okay to sell below 14. You can use a wide stop and scale in. I think always in bulls, if I'm a bull, I would get out below 14 for sure. Too much risk to get a downside breakout. If you don't sell below 14, well, what do you do? 15 is the bear bar closing on its low, and 16 is the bear bar. Well, then you sell. But there's the added risk that this is leg 1, pullback leg 2, which would lead to a possible breakout of bull flag. Whenever you're in the trading range, I'm always thinking about the possibility of the opposite. So here, it looks like a second leg down is likely, but we're in a trading range. Therefore, the opposite could be just as likely, and we could get this. Also, yesterday was a reasonably sized outside bar. That means today probably will try and be an inside bar. It's also an FOMC day, so we have to be wondering about the potential of the market going sideways into the FOMC into the FOMC report. So the bears, they want leg 1, pullback leg 2, and they're probably going to get to this low right here. I'll make it magenta so it stands out. They're probably going to get there. The bulls want the opposite, and they want an upside breakout. So to me, I'm not sure what's more likely. Therefore, I am personally just going to wait. But the bulls did not have a credible buy anywhere in here, so I think most would exit here. Strong enough breakout, probably a second leg down, likely. But this is my concern. I have this measured move drawn from the 9 low to the 14 high projecting up. I have it drawn for a reason. And my reason is that this is a real risk for the bears. So if I did short below 14, which I did not, I would probably, I don't know, I'd probably exit above 14. Even though the market's probably going to get stalled at this blue line, which is, well, there's two things. There's a blue line right here, which is below bar 1, which is where bulls got trapped. The other problem is open of the day. You have to wonder if we are going to get drawn back to the open of the day. Most of the time, in a trading range environment, the open of the day, OOD, open of day, is an obvious magnet. So here you go. This is why I get out above this bar. So how do you buy here? Well, there's a couple ways. If you're really aggressive, you can look at a 1-minute chart. Most traders should not do that. And enter on consecutive strong closes. But for the bulls, 1 second here. The bulls will see this as 2 legs up. Bulls will see this as 2 legs up. So, reasonable to buy. And if it races up, that's what I want to see. And if it starts to stall too long, I'll exit. I am in a position in my other account, so I took the same trade in my other account, so I'm trying to think about, I need to manage it. In this case, I'll probably just exit at the open of the day. So 68. Give me just 1 second. I need to make sure my orders are in the right place on my other account. That looks like they are. So that's good. And we'll just say 67 even, make it really simple. Typically when I take a trade, I will just put it at kind of around, I'll put it a little bit below the target. So if the open of the day is 68.75, I'll just put it maybe a point lower. I'm not trying to, and I'll often take part off somewhere around here and hold the balance. Now, why wouldn't I just hold betting we get up to here? Well, I am kind of a scalper at heart. And for me, I would rather just get out when I have a reasonable profit. So a lot of times I end up just kind of selling at the market. So buying and then just closing the trade for, 4, 5, 6 points and then just re-entering. But okay to buy here. The only problem with the bulls have is this is a tight trading range and bulls got trapped here. So the bulls buying here, you can see some of them are disappointed. Okay, I just got out. Even though it'll probably go to the open of the day. For one, I have to be careful, I have to be careful about not doing too much as far as I need to focus on the actual trade I'm in, for one. But number two, the risk reward, for me, I get the risk, technically the stop's down here. That's just an arbitrary stop to me. I'm going to get out pretty quick. In this case, I'm buying a possible second leg trap right here. And if I'm buying a second leg trap here, I need the market to go up very fast. Because the one thing I don't want is I don't want to get trapped and do something that would cause me to, sorry about that. I don't want to get trapped on a possible second leg trap and then have to sell for a loss. You know, again, like I've said a couple times, I like high probability trades. That is my preference. So if we're trying to get to the open of the day, trying to get up to here, probably, you know, one target is also the open of the week. Let me put my reminder that the FOMC meeting is today. So what do you do if 15 and 16 are consecutive bull bars? Well, traders will buy again, betting that the market is going to go higher. In situations like this, I typically would buy the close of the current bar if it closes above its midpoint reasonably on its high. So there we go. Should buy the close. Should buy the close. So a possible target is, give me 1 second, I need to adjust something on my other position. So sometimes what I'll do is take part off the open of the day and the rest off up here. And sometimes if I'm long, I may add to my position when this bar is a reasonable size bear bar, so I'll just buy more. And the reason for that is it's a bad short. So if this bar closes on its low, this is strong enough to probably lead to a second leg up. Therefore, if I buy the close, I'm in essence buying a pullback on a smaller time frame, and it'll increase where the risk reward is pretty good as far as it going higher. But in this case, I will hold for a couple legs up to see what we get. So 15, 16, breakout, follow through, buy the close, obvious target, bear flag above, just about the open of the day. So probably going up to there, may get to the open of the week. Measure move target from here to here. So that's another reasonable spot. For me, I'm just going to set a target a little bit around the open of the day. So I'll put a target at, I'll just take another 4 points. You know, my goal is, even though that target arguably could be a little bit small, I'm trying to make, you know, again, it goes back to basketball, trying to make a lot of layups and free throws. I'm not trying to hit a home run or a half-court shot. So reasonable, buy the close 18 for a second leg. The Bears, they want a second leg trap. They want to prevent 18. They want to create the current bar 19. They want it to close on its low. If it closes on its low, that may entice some bulls to exit. But for me, the only choice is long or flat. Too much risk that we're going higher. My reservation for the bulls is even if we get above 7, which I think there's a reasonable chance we will, my problem with 7 is it's a trading range. This is enough selling pressure to increase the odds that the market goes sideways. Also, we're 3 minutes and 30 seconds into the bar and we haven't gone above the prior bar. That is a strike against the bulls. And I'm a bull and I'm disappointed about that. Therefore, that is the reason that makes me question the strength of the bulls. You know, the key with trading is to really do reasonable things. You do not have to You don't have to take a lot of trades. You don't have to, you really just need to be reasonable. Take a couple trades that have decent math and manage them well, and that will get you a pretty far ways. So you can see the problem here, what I talked about on the 60-minute, it is a bad buy, sell the close bar. So it's a bad sell the close bar. That means the market is going to probably, more bulls will buy it. Yeah, is this reasonable? Price actionable asks, that's a good filter. It quote unquote, is this reasonable? And that's just something I picked up on Al through the years. I really think one of the great things about the Med Guy Always In is, you really need to look at the trading course to really understand Always In. Always In is just the higher probability direction. It's really all it means. But that's not such a simple thing to answer right at this moment. But you can also go to YouTube, type in, or go to the Brooks trading course. There's a Ask Al section at the bottom where it's a bunch of Ask Al videos. Or you can just YouTube Ask Al Brooks and Always In. And there's a good excerpt. But the great thing about the trading room, especially, I really recommend people go back on a, it's great to watch the trading room, listen to the trading room, but I'd also recommend go back with Al, and get a month, get a year's worth of just Al from several years ago even, and listen to it. And just, the key is to pick up on a lot of the little things he would say. And Rose says the same thing. She says it just in her, in her own way, but it's the same logic. Rose talks a lot about paying yourself. And that's the same thing I'm trying to say here. I want to exit. I want to lock in what I have. So from Rose terminology, I want to pay myself. So everybody always says the same thing. Both Tims would say the same. They'd have their own way of saying something, but it's all going to kind of mesh together in some form. But the key is, Mad Mo says takes a long time to understand what is reasonable, though. It does. It takes a very long time to understand what's reasonable. And, the great thing about trading is if you're willing and persistent to trade long enough, you make enough mistakes and you do enough dumb things that you learn not to do those. For me, I've made enough dumb decisions doing the wrong thing. The amount of times I've sold 12 or so below 14, and I just said, screw it, I'm not going to get out on 15. In fact, I'm just going to sell more on 15 and 16. And, guess what I would end up doing? I put a stop all the way up here, because Al says to put a stop up here. And I would scale in all the way, and I'd get stopped out here, take this incredibly large loss where I'd want to puke, and only look back and say, why wouldn't I just get out here? So the point with that is you learn, the longer you trade, you learn what's right and what's wrong. And that's really a key, is being persistent. The more persistent you are with trading, the easier it gets. So for me, I'm still basically break even on this trade. Typically I would buy more. I bought the close of this bar in my personal account, and I did not actually scalp out. I actually bought a little bit more as this bar went down, and I'm going to take part off at the open of the day, and I'm going to try and take the other half off back at the high of 7. So I'm trying to scalp out part and swing the balance. Ray Rowling says, yeah, that's a pretty funny quote by Al. He said it a lot. Would I take this trade? He would always say, would I take this trade? And then say, probably not. And, that's the reason for that is most trades just aren't that ideal unless you can manage them properly. Again, I'll challenge you. Just look at the end-of-day setups that Al does a lot, and you'll notice that all the stop entries, you could take those stop entries and typically make money if you're quick to scalp out. Ray Game says, I guess this breakout has reset the count. Yeah, it's a breakout of bull flag. That's my issue with being short here. That's why I said if you sold below 14, I can get out above 14. There was too much risk. 15, there would be a breakout and the count would get reset. Now, if possible, this is all one move. Leg 1 to 12, pull back to 14. Leg 2 to 16, pull back leg 3. But I don't think it's likely. To me, it's a trading range. Trading ranges are very forgiving. And one obvious magnet is the open of the day. Market's probably going to get there. And the reality is, we're probably going to go a little bit higher. So I'm actually, I forgot, I have a target right here, right at the open of the day. At least I think I do. I actually do not, so I'll just keep it like that for now. We'll see. So outside up on 18, might be some sellers, but who's going to sell below 19? Some will, but I think this is more profit taking from traders that are taking profits at the open of the day and aggressive bear selling for a scalp at the open of the day, more so than traders selling for a swing. Too much buying pressure. Reasonable to exit longs though below the 19 low. So you can see this is a reminder of disappointment. We now have 3 overlapping bars after a strong follow-through bar. If I'm a bull, I'm a bull. I bought the close of this bar. Do I want the market to go sideways? No, I want the market to do this. So I want the next bar. If I bought 16, I want 15 to be another really big bar and go straight up. And when it doesn't go straight up, I think to myself, maybe I'm wrong about the direction. I mean, maybe it's not as strong as I thought it was, and I should think about trying to scalp out. So, also another note, part of the reason why I often exit trades with less profit than my initial risk, and part of that is because I typically enter multiple times on the way up or down. So instead of holding the trade for a couple of legs, I try and re-enter several times. And the other portion is actual risk. My actual risk is typically smaller. So while my stop might be far, the actual risk is usually not as far. So I'm exiting this trade, just basically break even. It's disappointing enough that it's not really doing what I wanted to do in the first place. Probably will go higher, but I'll wait to enter pullback. I'm really resistant after seeing something like this. And to me, this is just it's becoming more and more disappointing. Disappointing. So I am just going to look to exit. Okay, I just got out. I took it out of my other position. Even though it's probably going to go higher, we're starting to stall in this area, and I don't want to be long in a trading range that's starting to stall. So, plus, we also had the FOMC minutes at 1. So, for one, there's going to be trading opportunities there, and I don't want to do something stupid and give up what I've made. Ray Game, if I didn't answer your question, yeah, this could be. I mean, it's possible this is 3 legs up, parabolic, 1, 2, 3, and it's reasonable for bulls to exit below this bar. It's strong enough that the market's probably going to go sideways a little bit, but it's dangerous. For me, it's too dangerous to hold below this bar. So even though you'll probably go a little bit higher, probably going to go mostly sideways. This happens a lot too, by the way. Open of the day, it did not get reached. It came close and turned down. And it's common for the market to give a really enticing sell signal like 19. However, there's an obvious magnet above. So if I'm a bear and I sell below 19, this whole time I'm going to be thinking, we're so close to the open of the day we didn't touch it. Could this be a trap? And what will often happen is the market will sell off and then break to the open of the day, and then it goes sideways. So it could be a trap selling below 19. So for most traders, if I am selling below 19, if I did, I'm not, I would typically look to sell more higher and use a wide stop. But this, to me, is too much buying pressure. I want to see the bears do more. There's also bulls. There's also a reasonable here, 2 legs up, so a possible second leg trap. So if that's the case, some bears would sell the close of 15 and they'd get trapped on 16. So what are they going to do here? Well, look what happened. See if I can show this right. So some traders, they sell the 15 low and they sell more below 16. Notice, really hard to see, but notice what happened here. Sell this close, sell more below this bar, maybe right here, maybe a little bit below. And if you basically had the choice to get out break even, that's in part what just happened. So I think we're still going a little bit higher. There you go. That's why I said this might be a trap, where the bears that sell below 19, they get stopped out above 19. Smart bears that sold below 19 sold more above 19, anticipating that this will happen. So tested the open of the day, starting to turn down. What about if 21 closes on its low? Well, you could argue it's a second entry short, 2 or 3 legs up. It's also kind of an expanding triangle. So you could argue a possible final flag, reversal. I think if this bar closes on its low, more bulls would exit. It's possible that the market will still go a little bit higher. For me, you could argue it was more or less, let's see something. You could argue it was done to get out below 19, and it probably was, but I am just really resistant in a trading range to selling all that high. So for me, I don't mind exiting. Some bears that sold below 19 and selling more higher, they may get trapped here. And if they do, then a lot of those bears may try and get out around break even. So can the bulls close above the open of the day? Can they get a bar closing on its high? The problem here, though, is the 3 pushes up, 12, 16, and 21. So not ideal. Traders that buy it, if they buy above 20 or 21, they exit below bear bar if it closes on its low. But dangerous to buy up here this high in the range when the market's probably going to go more sideways. So for me, I'm a little bit trapped out. I want to buy, but I don't like buying a possible third push. It's possible this is the first pullback, second push. So the market may get a little bit higher. So it's okay to be long here, betting on higher prices. Do traders scale in if they're long? If they're long for any reason, do they buy more below 22? For me, I would not. You could argue it's a second leg up and 15 and 16 was strong enough to reset the count. Therefore, 20 and 21 is the second leg. But the risk is real that the rally to 12 is the first leg. The breakout 15 and 16 is the second, and the third leg is 20 and 21. It's also at logical resistance that through this area over here. So most traders should be flat here. Probably going to oscillate around the open today for some time. Not a great sell below, but it's bad follow through after 21. And 21 is the best looking body or bull bar since this rally. That increases the chances that the market may go sideways. Probably buyers below 22, but I would exit any longs below 22 and wait for a couple of legs down. The other option is if you're long, you wait for 2 or 3 bear bars and exit if you're taking the chance the market's going to go higher. To me, this is not sustainable. Rally, pullback, breakout, pullback, rally, probably going sideways here. Market may have to have one more push up and form a wedge. One, that's the first push, 15 or 16, pullback to 20, second push, 21, 22, pullback, third push. Some buy the close bulls on 21 will be disappointed and look to sell out of longs back at the high close here. They buy the close 21, disappointed 22, try to exit break even back at the 21 close. Okay, so now the bears have 2 consecutive bear bars, big bar on 21. So more traders will exit below 23 as well. Other traders will wait for 3 consecutive bull bars. The other problem I have with being long here is I think the risk is real that the market will go down to 20 or 21. And also, we're starting to get, close enough to the FOMC report that the market may go more sideways. Even though there's a little over 2.5 hours before the report is released, if the market starts to go sideways, the one thing I don't want to do is use too wide of a stop to scale in and get trapped and be forced to exit a trade. Whenever you use a wide stop and scale in, the risk is real. You could get a deep pullback that could take a while to get back to your entry. So for the bears, for me, I'm not doing anything here. And in part, this channel's up is pretty tight and it's trying to form a small pullback trend. You can see that there's an obvious gap at the 19 high and the 21 low. So what do the bulls want? Well, the bulls want a measuring gap and an upside breakout. I won by above 23. Now the problem with the parabolic wedge argument, 1, 2, 3, is 15 and 16 is strong enough to increase the odds of at least a little bit higher. And the other problem is, typically when you get a parabolic wedge, it's common to get a micro channel that it pulls against. So with the market going above, with this current bar going above 23, it lowers the probability of the parabolic wedge argument. Also, the other issue for the bears is it's giving the bulls too much time to be able to exit. So the bulls are getting to decide. It's not forcing bulls out who bought the close at 21, which increases the odds that the market's going to go higher. So breaking out to the upside, buy climax, another buy climax, another buy climax, probably more sideways here. Strong enough breakout on 25, probably going higher. For me, I've not done anything with this bar. Consecutive buy climaxes, open of the week, high of bar 6. So probably going more sideways up here than going much higher, but strong enough surprise, 24 and 25, probably at least a small second leg up. Surprise bar, and let me fix the scaling here. Strong enough bar, probably going at least a little bit higher, but far away from, is it by the close? It is by the close, but you have to be careful up here. Getting to be a pretty climactic rally. The bulls are trying hard to get follow through here, and they might get it, but with all this trading range price action, I think the odds increase that the market is going to get drawn back down to the 7 high. The bulls are trying hard to get follow through here, and the bears are trying hard to prevent the bulls from getting follow through. So important bar here, strong enough breakout 25, probably going at least a little bit higher, but traders have to wonder if this day is going to lead to a bull trend day, or is the market going to get drawn back to the open of the week in high of R7? While the market is always in long, I'm suspicious of this bull bar 25. It's consecutive buy climaxes, and 25 might be a gift. If you bought anywhere down here, you just got a windfall profit far above the high of 7. So you have to wonder if are there going to be more traders eagerly buying the close of 25, betting on higher prices, or are there going to be more traders saying that this might be exhaustion and then we're going to probably pull back? I suspect the market's going to have to pull back here. And I wouldn't be surprised at all if this bar sells off. At least, well, it doesn't look like it's going to. There's only 30 seconds left. But to me, this looks fairly disappointing. But the bulls are getting good follow through here. So you can argue it's by the close and probably going higher. But it may have to pull back first. It may not go a lot higher before the market pulls back. Again, I don't think we're going to start. It's too early to sell, but I don't think we're going to start a strong bull trend here. We might, but to me, this is too climactic. Some bears sold the close of 24, and they're disappointed on 25. Or they sold the close of 25, disappointed 26. Some of them will try and get out, break even, back at the 25 close. So probably buyers down here. There's also bears that sold the high of bar 7 during 25 in their trap. So important bar here. Will this bar be a bear bar closing on the flow? Or will it be something weaker? For the bears, probably need at least a second entry short or micro double top before traders will look to sell. Another bear bar, but the bodies are getting smaller. Big bar 25, smaller bar 26, smaller bar 27. Probably going to pull back here some. But micro channel since 24, first reversal down may fail. Climactic behavior though, so the pullback could be pretty deep. Most traders are better off waiting here. You can buy the close, but you need a wide stop. And I suspect the market will have to pull back soon. For me, I'm not interested in buying up here. I'm looking to buy a pullback. It's hard for me to ignore the size of the opening range. Makes me less confident that we're going to break to the upside and get a measured move of this entire range. That means that I think this has a lot of influence over the market, and that means that the market's probably going to have to pull back. Now, the traders that are long, they're probably just trailing the stop, and they'll exit below bear bar, closing below its midpoint. So traders can be long here, but again, I think the market's going to have to pull back. So I'm resistant to buying up here. I also think this area down here is a magnet, but the market may have to go sideways and develop more selling pressure. So it is okay to be long here. You can see some of the momentum drying up from the 25 and 26 breakout. So probably going to start going sideways here. Most traders probably are better off being flat here. Bulls, I don't know. I would take profits. We may go a little bit higher, but I think it's at least 50-50. We test back down to here at some point soon. Three consecutive bear, 3-bar micro channel. So it might be more sellers above 32 than buyers. Bulls trying to form a double bottom with 28 and 32. Tight trading range, so I suspect it may go a little bit lower. Yeah, so Mad Mo asked, what's a surprise bar? Can it be with trend? A surprise bar it's a surprise breakout bar. But a surprise bar is basically something that will probably have a second leg. And, there's so many ways you can think through it. I like to think of it how Al thinks of it as you look at a bar and you say, that shouldn't happen. That's a surprise. It's probably going to go a little bit higher. Or that's a surprise. It's probably going to go a little bit lower. So the big question is 25 a surprise bar? Yes. 25 is also with the trend. The problem with 25, therefore, the odds favor a second leg. Breakout follow through. Maybe this is the second leg. Maybe the second leg's here during this bar. The problem with 25, at least to me, is tight trading range, and I think this is late in a move. So I think there's a greater risk that the market is going to pull back to these closes. If this was 20, for example, let's go back to what I talked about here at 15 and 16. Why was I not? This to me was a surprise and likely going higher. Now it's a surprise within a trading range, so it made me less certain. This is a surprise, but we've had a rally since bar 9. So this makes me more concerned. Bar 25 makes me concerned for the bulls. If I bought, I really don't want to be long really far away from the bar 7 high. And the reason for that is I just know the odds are that the bears that sell the bar 7 high are probably going to be able to avoid a loss. And in order to do that, that means the market's probably going to have to go sideways here. So there's also the fact that we have a report coming up. All of those reasons make me think the market is going to go sideways in here, which is why I'm so resistant to buying up here. Follow through, and then bull bars here, 27, 28, 29, but overlapping bars, 3 bear bars here, all overlapping. So now we have a 4-bar micro channel, and there might be more sellers above. This could be an endless pullback. There are bears who are trapped. They sold this high, they sold this close, scaled them higher. They're deciding what to do here. So I'm not discounting the fact that the market will get another leg up. I'm just stating my concern that I think there's a risk that the market may break to the downside. I did not buy below 30, and I would not be that eager to buy the 30 low. I think there's too much risk of a test down to the 27 close or the 26 close. Therefore, there's too much risk of us testing somewhere in here. So I'm concerned. My concern, I would not be all that eager to buy the 30 low. Oh, to sell it? Some traders will, but you know, I think it's better to wait for 2 or 3 consecutive bars. I mean, there's a reason. Look what's happening right now. We have a micro channel. The only way you form a micro channel when traders are trying to sell above bars, and so many traders are trying to sell above the prior bar, it's not getting filled. So that is a reminder, that is increased selling pressure. But the bears need to do more here. They really need to get bigger bear trend bars. So 34 is a bull bar, but it's following 3 consecutive bear bars or 3 consecutive non-bull bars. There might be more sellers above 34 than buyers. So the risk is real that you get a downside breakout here, testing the 25 close or the 26 close. For the bulls, micro double bottom, down on 32 or 33, up on 33, down on 34 and up on 34. And the bulls are trying hard to get a second leg up here. Why is the market hesitating, or why did it hesitate at around the 26 close during 32 and 33? And the reason for that is some bears sold. They were disappointed here, and they were trying to get out, break even here. Other traders may have sold the high of 25, disappointed, sold more below 30, trying to get out, break even during 32. 36, big bear bar, so big risk, possible triangle, tight trading range. If I'm a bull, I don't know, I'd probably get out below 36. If it triggers too much risk that we do test back down to the moving average, maybe the open of the week. You can see the bulls are trying hard to buy the close of 36 and prevent it from triggering. And so far, those bulls are doing a good job. So the bulls, they want a double bottom, 34 and 36, break out above 35 and measure move up and the test of the 30 high. Some bulls bought above 34 or 35, disappointed on 36, and they're trying to get out break even here. So this rally here on 37 might be more about the bulls trying to get out break even than the bulls buying aggressively, hoping for an upside breakout. And if that's the case, we could fall below 36 and then get a sell-off. Most traders should just wait until the report is released here in about an hour and 20 minutes. Bulls trying to get follow through after 37. The bears are trying to get a bear bar closing on its low or a second entry in a double top with 30. So, important bar. Will the bears get a bear bar closing on its low? Will the bulls get a bull bar closing on its high? Or will this bar be a doji? Bull bar, so that's good for the bulls. 38 failed to close above 37, so that's not good for the bulls. Probably more sideways. It is possible we just go sideways for the next hour and we wait to break to the upside or downside after the report. So really better to just wait and do nothing. The bulls keep trying to get the upside breakout above 30, and if the bulls keep trying and failing, traders wonder about the market doing the opposite and trying to break below 32. So some bears will see this as tight trading range. So a double top with 39 and 30, they'll want to break below 32, the neckline, and a measure move down back to the open of the week. So it would look something like this. Here's the double top. neckline takes you right to the high of bar 6, the high of bar 7, and that is reasonable. I think the odds are higher than it appears that the market can test down here. And it looks like the Bears are going to try and do it right here. So for bulls, I would not be long right here. I think there's too much risk of a downside breakout. The Bears are trying for a downside breakout and a break below the neckline 32. I took a chance and sold earlier, taking a chance that we would at least test the 25 high. I'm hopeful that we test the bar 6 high, and because it's at the moving average, I will be fairly quick to exit this trade. Normally, I do not like being in a trade an hour before the report, but I think the context is reasonable here, and I think the market's going to try and get down to the 6 low before the report. So if the Bears can get a strong breakout here, reasonable chance we test down here to the bar 6 low. So I'm paying attention to how the market is reacting to the moving average. What about buying at the moving average here? I would not. Too much risk that we have to get to the 6 low. It's an obvious magnet, 6 high, It's an obvious magnet in a trading range day. And I've said since bar 25, I said before then, that this bar, whenever you get a big sell-off on the open, it increases the odds that the market's going to form a trading range, and it's going to have a hard time staying far above it. That makes me think that the market is going to have to get down here. So let's see how this bar closes. Will it close above its midpoint? Can it close below the moving average? Let's see. It's possible we have to get down to the 25 low. If this is exhaustion, then the 25 low is the target, along with the middle of bar 25. Okay, I just took half off at just above the target, and I had the rest set to break even. And, if the next target for me is the high, it's ambitious, but it's pretty much the low of bar 25. I don't think we're going to get there, but I'm taking a chance that we crash on this bar and get back into this range. Depending on how this bar closes, though, I may just exit the trade at the market. It's possible that the market sees the 24 low as the bottom of this third leg. Leg 1, leg 2, leg 3. Therefore, the 24 low might be a magnet, and that corresponds to the open of the day. So it's reasonable we have to get down to the 24 low. Good close for the Bears, probably going at least a little bit lower, but I suspect a lot of traders will be fairly quick to exit. But probably too early to buy. I sold again. I added to my position on the close of the prior bar, and I want this bar to go straight down. And if it starts to go sideways or stall, I may just exit the whole thing and take what I have. In situations like this, with it being so close to the report, I want the market to go straight down. I'll take partial profits around the low of this bar, a couple points above it, and then final profits at the open of the day. So you can kind of think about like a 1 minute chart. I want to see this. The market's selling off, going lower, selling off, going lower. It's not going above bars. Makes me more confident that my target's going to get hit. So I just took half off again, and I've moved my stop to the high of this bar. And the reason for that is I would treat this a little bit different if this was later in the day. But my problem here, okay, I just went flat. My problem here is we're so close to the open of the day, and to me, this is a gift. It's a gift right before the FOMC report, and I don't want to be in a position. I don't want to do anything that's going to put me in a bad situation going into the report. So I want to be really quick to exit. So it still sell to close 42, still sell to close probably on 43. Even if 43 is a doji, it still probably sell to close. But the problem is enough of a sell-off that you're now getting into big up, big down. And this is kind of the minimum target. You know, I mentioned that the high of bar 6 was a target. I mentioned that the high of bar low of 25 is a target. Bulls, when the market gets down to the 26 high during 42, guess what they're going to do? They buy and they scale in. So for me, the reason I took profits just then was I'm expecting disappointment going into the report, and I want to be flat going into the report. So I got a gift and I took it. So I am going to stick around and discuss the FOMC. Now, Lono, I don't know if you can hear me if you're in the room, but I've been talking about this for a while. This is all due to bar 7 and 8. Too much selling pressure on the open that this made it too difficult for this rally to be sustainable. So I'm going to stick around and I will talk about the FOMC. I'm going to take like a 15-minute break and I'll talk about the FOMC. I want to review some of the prior FOMC days and talk about, I think, and the tendencies of the FOMC. The most important thing, the single biggest thing on the FOMC, I cannot stress enough, is trade small. You know, the FOMC, it's exciting because there's better movement, but personally, I don't like FOMC days. I'm not a big fan of the FOMC, and the reason, the longer I trade, the more I guess realize that it's a lot easier to deal with just normal price action. The FOMC, the bars are bigger, moves have a better, you know, there's a higher probability of surprise moves, and I don't like that. I'll still trade the FOMC, but I would much rather, I wish this would be just a price action all day. You know, my preference personally on this day would be we don't have an FOMC. We go sideways for a little bit. I could look to scale in, buy lower, betting that the market pulls back, and we just go sideways. I'd be perfectly happy with that. But, you know, the point I'm making is people tend to look at the FOMC because they have a small account and they think of it as, this is my chance to, you know, load up on contracts or make a 50-point move, and that's just not how institutions trade. So better to be flat here, wait for the FOMC, and if you can trade really small, trade it. Otherwise, wait for tomorrow. You know, the FOMC is not going to make or break your chances of doing well. So 42, if I was still short, I would just exit. You have a big rally on 25, big sell-off, 42, 43, probably going sideways. Also, the risk is big. By the way, I want to say something about the euro. So I think this is a pretty interesting situation. You have a wedge top. Yesterday was a big bear bar, and the bulls are hoping that it's 2 legs down. Leg 1, pull back to new high, leg 2. And the bulls want a second leg trap. And what'll be interesting to see is, I talked about this in the blog, but if this bar closes on its high, the bulls want to trap the bears and get a new high. However, this breakout, along with this, the past 2 days, is probably strong enough that the odds are the bears will probably get a second leg down. So this bar might be a trap for the bulls. This might trap the bulls into a bad trade, and this bar may just be a retest of the signal bar from 2 days ago here. So it might just be a retest of this signal bar and lead to a second leg. It'll be, I forgot it was the FOMC day when I was typing this, but on the blog, but I think it'll be interesting to see how this bar responds to the FOMC. There could easily be sellers somewhere up here, and we could sell off for a second leg down. So it'll be interesting to see. Let me see here. There was, the dollar yen, pretty interesting. So 3 pushes down, 1, 2, 3. Wedge bottom, testing the lows from August down here. Failed breakout below the August low. And, you can argue 1, 2, 3, or maybe 2 legs down and another 2 legs down. Probably going to test 135 round number in this lower high before it goes much lower. So what do bulls do here? I don't know. For me, I would do nothing here. I think if you're doing anything, you're probably selling. But with it being so close to, 45 minutes away from the FOMC, you could probably sell, bet on second leg down. I'd rather just wait though and wait for something new. We may get all the way back to the 32 low. Bulls pop 32 low, buying more above the bull bar here. That means break even will be somewhere in the middle, like 85 even. So we may get to 85 even and start to go sideways. There were also bulls who bought the high of 25 or the close of 25 around this price level here. Those bulls bought during 42. They got trapped. So what are they going to do on the bounce? They're probably going to sell out of longs. They'll buy here, scale in lower, get out back to the original entry. This is my problem about selling up here. 3-bar micro channel, 2 bars closing on their highs. We could easily get all the way back to the 32 high before we find sellers. It is possible it's a second leg trap, leg 1 to 32, pull back for 5, 6, 7, 8 leg bars in leg 2. So we could easily get all the way back to the 42 high. Just like we tested the 25 low here, it's good that the bulls, they prevented 43 from getting to the 25 low. That's good. But I wouldn't be surprised at all if we get back to the middle of this tight trading range. This is a pretty strong reversal. So if this bar closes on its high, do you buy above the bar? Time of day, with the FOMC being only 40 minutes away, I would wait. C being only 40 minutes away, I would wait. At 12:30, I will talk more about FOMC and give some examples. Starting to stall back at the 32 low. Strong enough breakout, likely the second leg, but with only 35 minutes left until the FOMC report, better to be flat. Oh, thank you for that. I did not realize the mic was muted, so I will start over. Trading range. This is always what I expect on the FOMC, is a trading range. Just like on the 5-minute chart, I always expect the trading range to open. And that keeps me from getting in trouble, keeps me from getting trapped. So the first thing I'm going to do is wait for the first bar to close, then wait for the second bar, because more often than not, sure we've got one in here. Here's a good example right here. Big bear bar and then an immediate reversal. But then, even if you bought the bull bar, you got an immediate reversal. So imagine selling this close, getting stopped out, buying this close, getting stopped out. That would not be a fun afternoon. So expect something like this. Confusion. This is in the middle of the trading range. So I would be careful. Big bear bar, big bull bar. Wait for the follow through bar. Notice these trend days. FOMC, we were selling in a bear trend. This happened earlier this last year. Downside breakout. So the point I'm trying to make is trading range broke the downside, reversed up. This was already in a trading range. It increased the odds of reversal. Bear breakout, yes, but then in a bull trend. So we just broke below the trading range and reversed up. So here, one of my thoughts is leg one, pull back, leg two, testing the open of the day. I think the open of the day is going to be a magnet going into the day. And we could easily get down to it. So open of the day. That's one target. Open of the week's another target. Interestingly enough, we came really close to a measured move from the low of the day to the open projecting up. So we might have to get one possibility. First push, second, third, but that really doesn't look that great. So I don't think we're going to get that, but we may get an upside breakout and fail above bar 30 and then turn down. That's a possibility. I think the odds are lower that we get a bull trend. If we're going to get a trend, I think it's more likely to be bearish. But even if we get a strong bear bar, that's just two legs down, pretty decent rally. So probably a trading range, most likely. So the two rules. Rule number one, wait for, well, there's two rules. One, trade small. If you can't decide what small is 20% of your normal position size. Rule number two is, and these are guidelines, but might as well make them rules. Rule number two is wait for the second bar after the FOMC bar to close. So FOMC bar, and then there's another bar after the FOMC bar. Wait for that bar to close. Doing that will keep you out of trouble. It's always tempting to, just look at, this is a great scenario. Let's pretend this is the FOMC. Great looking similar FOMC situation. Bar 7 is a huge bear bar, outside down. And it's so easy to look at the bar and say, oh my gosh, I've got to sell right now, because if I don't sell the bar, I'm going to miss the giant trend that's about to happen. Well, go look at exceptionally large bars and figure out how many times they truly lead to trends, because it's not really all that many. More times than not, it leads to a trading range. So I would be pretty cautious about this bar. So in other words, I'd be cautious about the FOMC and assume it's mostly going to go sideways. I'll be back in about 5 or 6 minutes. All right, about 2 minutes before the report. So if anybody is long or short or in a position, probably better just to exit wherever it's at. It's so easy to be tempted. So easy to be tempted and be in a trade. And, let's say I sold down here and I'm just saying, it's so close to entry, let me just, it's probably going to get there. I'm just going to stay short and exit my trade. And while that may work most times, it's just so easy on a FOMC day for the market to just race up and just go right through your stop and get really bad slippage. So just wherever it's at, better to be flat and be prepared for the next trade. I do think we're going to the open of the day, but I don't know the path. we could easily go up to here and then go down. And it's possible we sell off, test the open today, and go up. If we did sell off here and go below bar 43, it could be a wedge here, here, and here. 2 legs down, 43, pull back to here. Let me just draw that just to maybe a reference point. One moment. So you can see 2 legs down takes to the open today. So about 30 seconds left before the report. Better to be flat. What if you sold the low tick and you tried to get out break even here and you stayed short? Now how are you feeling? So, and then don't be surprised if you buy up here only to watch the market go back down to here. So we could easily rally and be all the way back down to here pretty quick. Well, there you go. It's really important to just not be surprised by anything on the FOMC. Anything, I mean, even if this bar closes on its low and gets back to, I'd like to sell, but the reality is I just can't do it. I've got to wait for follow through, and there's just too much risk of it being at the low of the day. And I don't want to take one bad trade and give up whatever I've made on the day. And especially that's true on the FOMC. The bars are big, and it's, you have to treat the FOMC like a brand new day. That's the easiest way to do it. So just treat it as a different day. This is bar 1, and typically on bar 1, it's better to wait for bar 2. So this is the start of a new day. And, there's no rush. If you're going to have a strong trend day, the market could go really, really far. So there's no rush to do anything here. One of my favorite, I think it was in Al's the video course, but he mentioned how it's better to be a live coward than a dead hero. And always think about that with the FOMC. And it's better to it's better to wait. Don't do something stupid that you're going to regret. Just keep it simple and wait for the bar to close. And there you go. So, disappointing close. Bulls made money buying the 43 low, scaling in lower. To me, this is a trading range. I'll try and take a trade in, let me just make sure it's the way I want it. I'll try and take a trade here if it does what I want. So we shall see. But I'll try and do something. For me, I'm more interested in buying down here. Maybe if this bar closes on its high. And it's probably okay to buy the close at 55, but we need a wide stop. And I'm talking right now, so I'm a little resistant to that. 50% pullback from the low of this bar to the high of this bar. So big down, big up, probably going sideways here. It's easier to see it on a 2-minute chart. Big sell off, big rally, and 50% pullback, but may have to get all the way down to here first. Bulls want a micro double bottom. Down on 55, up on 56, down on 57, and up here. It would be a second entry buy and higher probability that we're going to go higher. But 3 consecutive bear bars, tight channel, so increase the odds of more sideways. What about shorting below 56? Some traders will, but I suspect more likely sideways than straight down. For most traders, probably better to just be flat and wait. Probability is not that great to be selling or really doing anything in the middle of a tight trading range. So limit order trading, not ideal for swing trading. Hovering around the open of the day. I suspect we're mostly going to go sideways here. But 1 minute left until this bar closes, so let's see how it closes. If this bar closes on a high, I would get out of shorts. It's a micro double bottom on the first bar of the FOMC on 55. You can look at it on a 2-minute chart. So down and up, down and up. And I think the odds are we're going to go back to here, this area right here. So I would be out of shorts for sure above the prior bar. One thing that's important it takes a while to get to this point, but it's important to get to where you can understand that this tail is a breakout on a smaller time frame. So here, it's a breakout, 3-minute chart, big bull bar, 5-minute chart, big tail. And that doesn't mean you need to jump back and forth on all sorts of different time frames trying to figure it out. But what it means is you have to understand what this tail down here implies. It's a breakout, so it's a bear sell-off and a rally. So on a 1-minute chart, big sell-off, rally. Disappointed bears down here, they'll use any pullback to buy back shorts. Big tail, disappointment by the bears, they'll use any pullback to buy back shorts. So we may get all the way back to the high of this bar and go above bar 55. So that is certainly one possibility. I bought early during 57, during 57 on a smaller time frame. I took part off basically at the high of this breakout, and I'm swinging the rest to the high of here. So, the way I see it is strong enough breakout by the close, traders will buy more lower, and the market should at least retest the close of this bar. I still think we will go up here though. So I was just, I meant to do something in the room. I'll still try and do something on, this is a simulated account. I'll still try and do something here. But I was distracted with the trade I was in, and unfortunately just couldn't do both. I truthfully also forgot to do anything here. This is why I took partial profits. This is a trading range. We may just go sideways here. So for the bulls, they need, first let me clean up some of these lines. The bulls need a strong close. That's the first thing. They need a strong close, and they need the bar to close on its high, preferably. A lot to undo here. Pretty strong sell-off, so the bulls need to show a sign of strength. We still may get to the high of the day and go above it. Remember, the daily chart, the bulls want to close on its high and maybe above the outside day. That might be a little too far, but it's certainly possible. A day and go above it. Remember, the daily chart, the bulls want to close on its high and maybe above the outside day. That might be a little too far, but it's certainly possible. Back to the open of the week, this green line. If you can use the wide stop below 57. Otherwise, it's better to just be flat. Might be more buyers below the prior bull bar, 58, than sellers below. So this might be a trap for the bears, but this bar is pretty big that it'll reduce the probability of the market going much higher. So not ideal for the bulls either. There you go. Pretty strong second leg down. So probably always in short, testing the one low, but probably going sideways here. So this might be a failed breakout below 55, but strong enough 59 and 60, probably going at least a little bit lower, but all these tails below make me suspicious. 60, 59 and 60, strong enough breakout, probably at least a small second leg down, likely, and may get down to the 9 low. So as far as buying above a bar like 61, it would need to be a pretty good looking bull bar to attract a lot of bulls. And I have to sell that. So I'll sell the close and I'll put a stop below the low right here. We'll just say 39. And if it's a bad looking bull bar, we'll get out. So I'm short. I'm on a simulated account, and target is basically the 9 low. Basically the 9 low. The reason for selling is 60 is a strong enough surprise to at least have a second leg down. This breakout trapped traders. Bulls, there should have been buyers below 58, and when 59 came down this strong, it trapped a lot of those bulls out, and a lot of those bulls covered, which is what caused 60. And I suspect the bulls will use this bar to try and exit their short or exit their long with a bounce. But even if we get a bull bar, probably not going all that much higher. It's a possible wedge bottom, 3 pushes, 1, 2, 3, something like that. But when you look at this, you have to think that's pretty strong. Is 61 strong enough to reverse 59 and 60? It might be, but probably not. Probably going to have at least a small second leg down. So the bulls want a second leg trap, leg 1, pull back, leg 2. And they want the bears to give up above this bar. But strong enough 2 consecutive bear bars, probably at least a small second leg down. And if the bulls can get a double bottom, like a micro double bottom, and a second leg down from 60, they will have a better shot at the reversal up. So for always in traders, it's always in short below 59 and 60. Some of those always in bears exit above 61 and they'll look to sell again below bear bar. Other bears, always in traders, will wait to see if the bulls can get 2 or 3 consecutive bull bars before deciding to exit. 61, though, is a warning for traders. It's a reminder that the market is still probably in the trading range, and it's disappointment. So it's a sign of disappointment for the bears, and a reminder that 60 and 61 is not as 60, 59 and 60 is not as bearish as it could be. So let's see what the next few bars look like. Low one short below 62, probably more buyers below, but I suspect only for a scalp. Strong enough 59 and 60 that the market is probably going to have at least a second leg down. Disappointment for the bulls on 63. So let's see how this bar closes. Still, the bulls need to do more. And you can see the bears sold it. Some bulls, they bought, used a wide stop. Some bulls bought the 58 low, used a wide stop, scaled them lower, trying to get out break even here. Still may get a small second leg down, but this is definitely a reminder that the market is in a trading range. And that will disappoint bears who sold down here. In normal situations, I would sell and sell more as it went up. But in this case, I want to just show how a trader could trade one contract. So my target's pretty far away, basically the low of the day. So disappointment for the bulls, probably going to get at least a small second leg down here. Bulls trying to get another strong close and close above 63. That would be good for the market and increase the probability that this is a second leg trap and that the market's going to reverse. But the bulls need a strong close here on 64. The bulls are trying really hard to get a strong close here, and they're just not doing it. And if the bulls keep failing, then we're probably going to try and go the other way. Now, this will be the fourth, if this bar closes above the open, it'll be the fourth consecutive bull bar, which it looks like it's going to do. And that'll be a sign of weakness by the bears, and it'll disappoint the bears. So let's see if the bulls can get a close above the open, or can the bears prevent it and get the open to get the close to close below the open, which would be good. So small body, second entry short below 64, but 4 consecutive bull bars, not ideal. Still strong enough breakout 59 and 60 that I don't think 61 through 64 is enough to reverse the downside breakout. That makes me think that the market's going to at least try and have a second leg down. I am still short, but if this does not go somewhere quick, I'll be quick to exit. Some bears trying to get out at the low close. Bulls are trying to get an endless pullback still, and this will be a second entry buy. So I suspect if this bar closes on its high, it would be reasonable for bears to exit above the bar. Some bulls buying the low of 64 and scalping out, and which is why this bar turned down in the final minute or so of the bar. So 8 seconds left in the bar. Let's see how this bar looks. Will it be another doji bar, or will it close near its high? So disappointing for both sides. Forgot I was doing that. Most traders will get out above the prior bar. Forgot I was doing that. Most traders will get out above the prior bar. So becoming always in long. Let's see what the bulls, if the bulls can get consecutive strong trend bars here. If so, this could reverse up pretty quick. Probably going back up to this green line, the open of the week. But the bulls need a strong close here. Always in long and probably going higher and back up to here. But it'd be better for the bulls if they can get one more bar. But 66 to me looks like a give up bar. And my reasoning for that was 66 was likely the bears giving up. Bears tried to get a breakout on 59 and 60. They failed, and on 66 it reversed up. I didn't buy it in the account on the I didn't buy it on this, and I'll try and do more of that. It's just really hard to do both at the same time. And sometimes I really need to think about what I'm doing. So it just doesn't always work out. Testing the close of 58, but the bulls need follow through here, and that's a sign that the bears are taking some profit. That the bulls are taking some profits. But small tail below 67, good for the bulls. The bigger the bar, the better. The smaller the tail, the better. The bigger the tail, the more disappointing it will be for the bulls. It's possible we rally into the close, and if the bulls are going to do that, they need to get signs of strength here. So let's see how strong the bulls are. It's possible we get back to the blue line high yesterday, but if we're going to do that, we're going to see there's going to be signs of strength. There's going to be strong bull closes. So let's see what this bar looks like. The bigger the bar, the better. We may just go sideways at the top of 59. It's possible if the bulls are lucky, we get a rally. So consecutive bear bars, it failed to go up, failed to go down. So maybe it'll go up and we rally up to here. But if we're going to do that, this needs to be strong. My hope is we get a strong close here and we rally into the close. Although this is going to be pretty early for a rally, it's possible that we get up to here before the end of the day. Looks like the bulls are going to get good follow through, which is good. It increases the chances of a second leg up and a rally up to the blue line. For me, if talk about always in, if I'm short, which I was in the simulated account, when this happened, I had to get out. And I really should have gotten out of here, but I was focused on my personal account and managing a position. So either way, when you see this, you're wrong, you get out. And now for the bulls, the bears, it's always in long. There's just no way I can be short right here. Strong enough breakout to reset the count. Possible measure new projection takes you up to the 59 high. So if anything, you're buying, betting on a second leg up. Yeah, med guy 65 is reasonable. It's second entry buy. So it's a reasonable buy for the bulls. So disappointing for bulls. Reminder that the market is in a trading range. Probably buyers below 67 now, and at least a small second leg up. So disappointment bar for the bulls on 68. Closed at the midpoint, went below 67. High one buy above 68, but a pretty big bear bar. So while the market will probably have a second leg up, there's probably sellers not far above, maybe at the 59 high, this bear bar right here, which is also the green line, the open of the week. So there might be more sellers up here than buyers, and a possible third leg up, leg one, leg two, leg three. 68 was enough of a sell-off that the market had to have a small second leg down. You can see it here, strong enough sell-off, second leg down. Now the bulls want a double bottom and a rally. So we'll see this as a micro double bottom, and they want to rally up to the open of the week. And micro double bottoms are really just second entries. They're two legs down on a smaller time frame. So let's see, 40 seconds left in the bar. Let's see how it closes. I won by above 69, but a bear bar and a 3-bar micro channel lowers the probability of the buy. Still strong enough breakout, 66, 67, probably at least a small second leg up. The bears want an endless pullback and a sell-off back down to 60, but tight enough channel, first version down probably will fail. Bulls trying to get the second leg up, and at a minimum, we want to get to the high of 59, but the bulls need to show signs of strength here. Otherwise, there might be more sellers above the high one. I suspect this breakout on 66 and 67 is strong enough that we're at least going to have to go a little bit higher and probably reach the 59 high. So, important bar here. Will this be a bull bar closing on it? Will this be a bull bar closing on its high, or will it disappoint the bulls? What would it take for me to sell here? Well, it's always in long with 66, 67. Therefore, I'd rather be long than short. If the bears can if they can string together consecutive bear bars, if maybe this current bar can close below, okay, that's not enough. I was going to say if it could close below 69, but so far, this is not enough to make me think that the bulls are eager to exit yet. The bulls are disappointed. The bulls that bought 66, 67, they are disappointed, but they're not willing to get out of the trade yet. Continued disappointment for traders. So let's see how this bar closes. Bulls buying into the close, trying to prevent this bar from closing on its low. Possible 2 legs down, leg 1, pullback, leg 2. You can see bears sold 69, the high 1. So let's see if the bears will be willing to sell into the close, or will the bulls buy into the close. It looks like traders bought the bar into the close. Still a pretty big bar, decent sized body, but the bears probably need one more bar to make it always in short. And if they need one more bar, you know what that means. You know that the bulls will buy this close, betting that the bears fail to get one more bar. So let's see what the bulls can do here. Continued disappointment for both the bulls and the bears. So this is not what you want to see. Bears trying to get out. The bears got trapped selling down here. They scaled them higher, trying to get out break even. Bulls got trapped buying. They're scaling them lower, trying to get out break even. Both of that increases the odds that the market's going to go sideways here. It's possible that 66 and 67 is a second leg trap. Leg 1, pullback. Leg 2, second leg trap, and that we have to get to the 66 low. So it's interesting. Bar 59 and 60, it's in the middle of the range, but strong enough breakout, probably should have gotten the second leg up. And you can see it trapped traders. And in fact, traders got a measure move down instead. And what's interesting about it is these traders, if you think it's kind of weird to say, but they shouldn't have been trapped. They bulls bought during this breakout, they bought this low, they scaled in lower. And what did this allow them to do? It allowed them to exit the trade around break even. Bulls that bought 72 right here, they bought this pullback from 66 and 67. They tried to buy 50% pullback and the bears got a downside breakout. So what's going to happen around 72? Probably the market's going to go sideways. So there might be more sellers up here than buyers. But, only a few minutes left in the day, really. Probably not going all that far from the open of the day or below here, so probably just going to go sideways. Fairly interesting day overall. Let me open up the question box. So pretty good rally back up to this area. And, trading range days are filled with breakouts that fail, have really deep pullbacks, and end up letting traders out back at the extreme. So big sell-off, deep pullback, but of course, the market retests below close. Big rally, deep pullback, and the market lets those traders out, as you can see it did right here. Big sell-off, but even this pullback here, traders got out. The bulls that bought here, a lot more lower, they were able to get out. And that happens just all day long. Daily chart, another doji bar in a tight trading range. So more disappointment for both the bulls and the bears. So breakout mode, 50-50 chance you get an upside breakout, 50-50 chance you get a downside breakout. I still think the odds slightly favor an upside breakout in a test of the the December 6th low. Weekly chart went above the high of last week and forming a doji, so starting to go sideways. And we may close around the open of the week. So the day overall, a lot of trading range price action on the open, big rally, and then trading range really for the rest of the day with pretty big swings up and down. First part of the day, gap up in the middle of the tight trading range, in the middle of the trading range day on the prior day, open of the week. So pretty big bear bar, tail below, probably buyers below and sellers above, and sideways. The bulls, to make the market always in long or short, the bulls need consecutive bull bars, bears need consecutive bear bars. Bar 2, bull bar, but closed under the one high. So not ideal to buy above. And in fact, probably sellers above. Bar 3, bear bar closing on its low. You can argue kind of a wedge top, 1, 2, and 3, but 3-bar micro channel, so probably minor reversal and not going much lower. 4, a doji bar, but you can argue high to buy, probably sellers above and at least a small second leg down. But bears, disappointed who sold below 3, disappointed 4, may try to use 5 or 6 to get out, break even. 6, 2 consecutive bear bars, and for the bears see a breakout pullback short. The bulls see a second entry buy, double bottom with 1. You can take the buy for a swing, but not really ideal, forcing traders to buy and sell in the middle of the tight trading range. 3 consecutive bull bar closing on its high. Some traders will buy above its stop below, but forcing you to sell in the middle of the tight trading range may get a second leg down from 3, so not ideal. And 7, huge outside down bar, enough of a surprise to make the odds favor at least a small second leg down, but a lot of trading range trading in here in overlap, and this might just be a vacuum test of resistance, these highs up here. So you have to be, if you're selling here, traders need to be quick, and if the market starts to stall, consider getting out. 8, breakout follow through bar. You can argue sell to close, but big bar, big risk. So some traders, and also the problem with selling the close down here is the market may have to get a deep pullback back up to here before the bears come in. So okay to sell the close, but I suspect bears want to sell higher. And 9, 2 legs down, leg 1, pull back, leg 2, but 2 big bear bars, doji bar above 9, probably sellers above, and the market's going to go sideways. 10 and 11, 10 is the low one short, 11 the market bulls bought below the low one. So you can argue somewhat of a micro double bottom, down on 9, up on 9, down on 10, up on 10. But tight trading range, probably finding resistance back at the 9 close, the 7 close. So probably not going much higher before the market has the second leg down. 12, a bull bar, closing on a tie. You look at a 15-minute chart, it looked like this. Big bull bar. So big sell-off and then disappointing pullback. Traders need to wonder if the bulls may get bull breakout of bear flag and measure move up. 13, a doji. So more disappointment and confusion for both sides. 14, second entry short, but forcing traders to sell after a micro channel lasting 4 bars in a very small doji with a small body. So probably buyers below at least second leg up. 15, surprise breakout, strong enough breakout for probably at least a small second leg up. If the bull buys the close and they get a big bear bar on the next bar, they have to get out. 16, follow through, testing up here, possible 2 legs up, leg 1, pull back leg 2. But 14, 15, and 16, strong enough breakout for at least a small second leg up. And it's possible 18 is that second leg up. 19, second entry short, micro double top with 17. So the market went down on 7. It went up on 16, down on 17, up on 18, down on 18. Reasonable for traders to consider exiting below 18, but if they do, they have to look to get long again. Open of the day is just above, so this might be a trap, trapping bears into selling at a bad location and trapping bulls into selling out of longs. And then 20, double bottom, second entry buy with 17. Reasonable buy above the bar, betting on an upside breakout and a second leg from 15 and 16. Surprise bar, 21, probably going at least a little bit higher. 22, bear bar, you can argue a wedge, 12, 16, and 22, but I suspect 15 and 16 strong enough that the market will get 2 or 3 legs up. So if 15 and 16 reset the count, that means this is leg 1, pull back leg 2 on 21, and then leg 3 is right here. 24, another high 1 buy, but after this bar here, strong enough surprise on 21. Also open gaps here that most traders wait for at least second leg up. 25, a surprise bar breaking above the high of 7. While it's possible the market gets a measured move up at the opening range or the low of bar 1 to the open of the day projecting up, more likely there's going to be sellers somewhere up here. So bears, they'll sell the close, use the stop, maybe a measured move up of this bar or a measured move up of both of these bars. Betting that the bulls will scalp out and the market will retest the lows of these bars. With 24 and 25 both closing on their highs, not really an ideal sell the close bar. Better to wait and see what the bulls can get. Aggressive bulls will buy, and they're betting that the market will have at least second leg up. If the next bar is a big bear bar, those bulls get out. Follow through on 25, 26, so buy the close, probably going higher. 27, 28, still bull bars. 28 went below 27, so low 1, or it's a bad low 1, so it's a pullback from this breakout, probably buyers below and at least going a little bit higher, and you can see it did here. 30, you kind of call it a parabolic micro wedge, 1, 2, 3, but not really that good of a shape. And this is all probably minor. Reasonable for bulls to exit below 30, betting that the market is going to get down to here before it goes much higher. So a lot of bulls would prefer not to be long up here. 32, 33, 3 consecutive bear bars. 34, trying to break above. The bulls see 34 as a double bottom of 28, and they want to measure move up, which will take you to the highs up here. So they see this, and they want an upside breakout. The bears, they see 34 is a pullback from this micro channel. 35, double top with 31 or 30. Second bull bars, make it a small second leg up. Middle of a tight trading range, so better to do nothing. And then 36, big bear bar, double bottom with 32. The bears want to break below the neckline. The bulls want to double bottom, measure move up. So triangle, tight trading range, probably going sideways. 3 pushes down, 1, 2, 3. 2 pushes up, 1, 2. 37, bull bar, breaking above the neckline of a double bottom, and neckline being above 35. 38 is the breakout. 39 follow through, but you can see the body's getting weaker, and then looks like the bears gave up on 40. 41, bear bar, and 42, a very big give up bar. Breaking below, it's a second leg down. 2 legs, leg 1, pull back leg 2. 42 is strong enough that the market's probably going to go at least a little bit lower and probably get to the 25 low, the minimum, or at least near it. May test the open of the day. With the FOMC report being not that far away, most traders should consider getting out and waiting for the report. 44, 2 legs down, but after this steep of a micro channel, probably sellers above, and the market's going to go sideways. 3 consecutive bull bars. 50% pullback from this sell-off, probably buyers below and probably sellers above. Strong enough breakout, 44, 45, 46, that there's probably buyers below for at least second leg up. Bulls got a second leg up. It went above 42 and found sellers. So some traders sold to close at 42, sold more above 42, and they're trying to get out break even right here. And then 54, testing the low closes here. And FOMC bar, 55, big outside down bar, but it's a pretty big doji bar with an impossible 2-legged trap. So some traders will buy the close, betting that the next bar is an inside bar and the market rallies. Strong enough outside down bar, though, that there's probably buyers above, buyers below, and sellers above. And this is more likely to be a trading range. And then another bar, an inside bar below 56, but still probably buyers below. This tail is a breakout on a smaller time frame. So it's a breakout and a pullback. Bulls want the second leg up. Double bottom, 57. Reasonable for the bulls to buy on 58. But 58 is forcing traders to buy in the middle of a tight trading range. And you can see the bulls that bought quickly got trapped on 59. 59 is a pretty big bear bar, and the bears will see it as a double top with 56 and 58, and the bears want to break below the neckline and measurement it down. I suspect with this much buying pressure that there's probably buyers somewhere down here, so even if the market does get a breakout and follow through, it'll probably go sideways more than straight down. So pretty big bear bar, 60, but 2 or 3 legs down. Leg 1, pull back, leg 2, pull back, leg 3, or just 2 legs down. Testing back at support down here. The bears originally got trapped selling this high, and you can see the market broke below it, tested the highs, and started to turn up. 61, 62. 61 is a possible second leg trap. Leg 1, pull back, leg 2. It's okay for bears to exit above, reasonable for bears to do that. Odds are that the bears will still get the second leg down now. And then 64, you can call it a low 2, but 4 consecutive bear bars. So odds are there might be more buyers below than sellers, and the market's probably forming a tight trading range. Bulls that bought anywhere in here, scaled and lower, made money. It was reasonable for bulls to buy the 58 low and scale and lower. So you have to wonder if they're going to make money as well. And the 65, you can call it a double bottom, second entry buy. Reasonable for bears to exit above 65 and look for another trade. And 66, big bull bar. Is 66 by the close bar? Probably is. Strong enough bar, probably going at least a little bit higher. And then 67, another big bull bar. The problem with buying 67 is it's closing. 1 second. Problem with buying 67 is it's in the middle of this big bear bar. The bulls got trapped in here, and any bull that got trapped and scaled and lower will probably be able to avoid a loss here. So not really that ideal of a buy the close bar, but it's reasonable for bulls to buy betting on a second leg up. The other problem for the bears is the bears sold this close and never had a chance to get out break even. So you have to wonder if those bears are going to be allowed to get out break even. 68, 69, you can call it. It's 2 consecutive bear bars. Pretty big, pretty disappointing sell-off for bulls. Bulls bought the close 67, and the market let the bears out here. So if the bears sold here, scaled in higher, they got trapped on 67, and the market let them out down here, and it's hovering down there. So that is a sign of disappointment and overlap. I bet we could see it pretty easy on a 5-minute or a smaller time frame. Yeah, so here's 2 or 3 pushes down, wedge bottom, and then a lower high, and then the bears got to break out below the wedge and a couple legs down. I won by above 69, but bear bar and a doji, so there might be more traders using this bounce to get out of the trade around the 67 close. And in the 71, big bear breakout bar, 2 legs down, leg 1, pull back leg 2. It's possible this is a second leg trap. So low 1, low 2, bull breakout, low 3. So 3 pushes up, 1, 2, and 3. For the bears, they see the bulls see 2 legs down, 69 and 71. They want 72 to be a bull bar closing on its high, and for the bulls to get a second leg up. But the bears instead got an inside bar, so you can argue it's a breakout and follow through bar, and they started to sell off into the close. Some bulls would buy the 66 low, betting on a second leg trap, leg 1, pull back leg 2, and they'll buy this low, use a wide stop and scale and lower. Although this is a fairly tight channel, it looks parabolic. 1, 2, 3, 1, 2, 3. Probably we'll reach the 60 low and go a little bit lower. But the market will probably not go much lower. 75. Now it's 5 consecutive bear bars, but pretty big tails below, so probably forming a parabolic wedge. Also, a lot of buying pressure in here. So the bears that sold down here, they got trapped up here. They're probably going to buy back shorts somewhere down here. The bulls that bought and made money, they're going to expect the same thing and look to buy again down here as well. Also, bulls got trapped buying up here, so they'll likely scale and lower, confident that the market will allow them out break even. 76, big enough surprise bar, always in bears exit above, probably going at least a little bit higher. And same thing with 77, and then 78 tested the 67 close, allowing traders out. And the market's pretty much going sideways from there. Credible stop entries of the day. You can sell below 3, but not ideal. Same thing with buying above 6, tight trading range. And what about selling below 7? You could, most traders shouldn't. If you sell below, the odds are there's buyers not far below. So if you sell below 6, if you can take the sell below 7, better to scalp out. And traders will buy above 15, 16. Traders will buy above 20, betting that the market will go higher. And not really all that easy in stop entries today. You can buy above 20, breakout pullback, buy above bull bar 24. Some traders will sell below 40 or 41, betting on a downside breakout test of 7. But again, not that ideal. What about buying above 44? I would not too close to the report and too tight of a channel. Reasonable buy above 57, second entry buy. But if you did, better to scalp out at the moving average, especially if the market starts to turn down. And maybe buy above 65, but dojis, lack of bull bars closing on their highs is not that easy. And maybe sell below 72, but pretty difficult. And, maybe buy above 76, but tight channel. So let me talk about always in for a second. It was clearly always in short on 6 and 7, but it has to be yesterday's close. So you have to be thinking about the possibility of big up, sideways, big down, and the market forming a double bottom. So if the bears did sell, they have to be able to get out probably above the 14 high as 15 goes outside up. And always in long through here, bears probably start selling below 40 or 41 if they're aggressive. And I would do nothing in here. Always in short below 56, probably not. 50% pullback, tested the 24 low and big tail on 55. So bears probably get out above 57. Bulls, maybe they buy above 58, but if they did, they would take the loss below 58 as this bar started to turn down. Aggressive bears, reasonable sell below 59 if they can use a wide stop up here. 60, it's arguably always in short, but possible 3 pushes down, so dangerous. Lots of buying pressure in here, increases the odds that there's buyers below, and the market's going to go sideways to up. And 66, 67, you can take the buy, but the bulls got trapped in here, so they may use this bounce to sell out longs more than buy back shorts. If that's the case, that means a lot of traders may exit below 72. A bear bar closing below its midpoint, especially with this channel becoming as tight as it is. And then always in bears exit above 76 and always in bulls buy. Limit orders, you can sell above 4, sell above 5, and sell above 9 or sell higher. Probably buyers below 10 and probably buyers below 22, but pretty dangerous trade. And then probably buyers below 17, buyers below 27, and then sellers above 33, 32, during 35. You can argue sellers above here, but 2 legs down, testing below the moving average, testing the open of the week, testing the bar 7 high. So close enough to the report, I just wouldn't do anything. And probably buyers below 62, maybe buyers below 64, and sellers above 69. Buy the close, sell the close. You can sell the close of 7 if you can make quick decisions and get out fast, and then buy the close 15, 16. Probably buy the close 21, but possible 2 or 3 legs up, so we need to be quick to make decisions. Buy the close 24, 25, 26, but you're breaking above the 7 high, so it may not go much higher. Probably sell the close 42, but if you do and you see 43, best to just exit pretty quick and sell the close. Sell the close 59 and 60. What about buying the close 58? You can, but a lot of overlap. You're basically buying in the middle of the tight trading range. And buy the close 66, 67, but 67, same problem over here. The bulls that bought on the way up got trapped on the way down. They used this bounce to exit. Same thing here. Bulls got trapped on the way down. They used this bounce to exit. Probably sell the close 72, 73, but 74, testing the 60 close, 75, going under the 60 close, probably bears buying back shorts and bulls, aggressive bulls buying. Let me take a look at questions. One was long at 67. Whoops, there we go. Question box moved around on me. Let me get it pulled back up. There we go. So let me see here. Question, I was long at 67 here. What was the appropriate sell signal below 71? I think you're saying, so this person's saying they were long here, when should they have gotten out? That's pretty tough, because the problem with, you have to think about the logic here. So let's walk through being an institution for a second. So if you're long here, and this sounds pretty crazy, but it works on almost every trade. Let's pretend that you want to buy the 58 close, okay? And you're going to use a stop, measure it down, maybe from here. So buy this close, here's your stop, you're going to double it down here. And you're going to scale in, so you'll buy this close, you'll buy more here, you'll buy more at this low. And if you think about it, what are you going to do with this? You're going to say, gee, that's disappointing. I should probably exit. If the market comes back to my entry, I need to get out. Now, obviously, you're better off getting out on the way down, but the point is, what is this doing right here? This is right where traders got trapped. I bet we could see the same thing on this bar here, 58. So let's go like a 2-minute chart. And there it is. So let's think about this logic right here. Why is this a bad buy? Well, remember what I talked about this tail? 56 is a bear bar, but it's got a big tail, so that's buying pressure. And think about the logic. It'd be like this. So I'm going to buy the close of this 2-minute chart. I'm going to buy the close of this bull bar. That bull bar corresponds to this tail. And it takes a long time to really understand, but I think it's reality. I'm going to buy the close of this bar, and what am I thinking here? I'm thinking, darn, I just bought at the worst possible price. I got an idea. I'm going to buy more lower and use a wide stop. So I buy more lower. What am I going to do here? I'm going to say, Al calls it the thank you God trade. Thank you so much for allowing me out of this really bad trade. And, it's the thank you traders. What are they going to do up here? Well, they bought up here and they got trapped. So they're going to sell the longs. The bears, what do these bears do? They sold and they said, darn, I sold the low close. I'm going to sell more higher. What am I going to do here? I'm going to buy back shorts. That happens all the time. So these bulls, they're buying where traders got trapped. Let's look at a 1-minute chart. Think about the same logic. It's very important you guys understand this. So bull breakout. I'm going to buy this close right here. And I'm going to be super smart, and I'm going to use a really wide stop here to here, somewhere down here. And I'm going to scale in. I'm going to buy, and I'm going to buy more down here. Well, what am I going to do if the market goes back up to here? I'm going to say, oh my gosh, that was a terrible trade. And I bought this close. I bought more below this bar. It's letting me out break even. I need to take it. Sells off. Bears, they sell the close. They sell scaling higher. What are they going to do down here? Take profits. So to your question, this happens all the time in a trading range, but what are you going to do if you bought up here? Let's pretend you bought this close. So let's pretend you bought the 67 close, the 58 close, and you held through 60, and you bought more lower. What are you going to do on the 57 close? Are you going to say, gee, I'm so happy, I want to buy more? Or are you saying, wow, that was, beyond disappointing. I just want out of this trade. I'll be thrilled if I can get out of my break-even price. And that's what happened. It's the same thing as the traders who bought, I don't know, pick anywhere. they sold down here and the market's retesting this price level. What are they going to do? They're going to buy. So I hope that answers your question. And the problem with where do you get out is when that happens, it's usually not that clear, because when it's obvious, then there's not that many scaling traders left and there's greater potential for downside breakout. When it's not so obvious and traders are forced out of the trade, then like here, these traders just got trapped, but it's 2 legs up. So it's technically a double top, and it's not the greatest buy in the world. Therefore, there's greater risk traders to get trapped here. So if you're buying here, the best thing is, maybe price goes below this low again, maybe on this close, certainly here on this close. And if you can think about it, buying pressure, these tails are buying pressure below bars, and then 73, 74, 75 have tails below it. That's buying pressure, testing the low of 60. Therefore, traders use it. Therefore, traders are going to see the same thing down here. Bulls are buying back, bears are buying back shorts, and bulls are buying. So that's the hard part. You have to get out and then find a way to get in here where the market's retested. So you're not alone in that. That is the challenging part of trading ranges. What time of day do you look at the encyclopedia? I typically look at it all day. I need to remember to keep forgetting to show it. So I'll start working on showing it more when I'm in the trading room. It's just easy to forget. But it's helpful, and I highly recommend, just take the trading room, just take the encyclopedia, and just start going through it. The first thing I would do is, I think I've still got it pulled up. Let me check. So the first thing I would do is go through this whole, understand the spreadsheet and understand where everything is. Learn how to look things up on the spreadsheet so you can then learn where bull channels are. So case in point, if there's a gap up day, one of the first things I'm going to gap up, and I want to see, so you can then learn where bull channels are. So case in point, if there's a gap up day, one of the first things I'm going to gap up, and I want to see gap up T1B. So trend from the open down. And I want to be able to just find these, or gap up, trend from the open, trading range. So I try and look at it all the time. Would you consider the bar 43 low as the breakout point for 55 with measured move down? There we go. Okay, so would you consider trying to adjust this question box? Would you consider bar 43 here low as breakout point for 55 here with the measured move down to the 58 area? So I'm assuming you're talking about something like this. Yeah, it's reasonable. It's double top. So double top, here's the neckline. Measure move down. You also say here, but you've reached both of those. So yeah, that's certainly reasonable. So the question, I'm always hesitant to trade a triangle breakout because there are always bars to the left providing support and resistance against my trade. What context or other factors support taking a triangle breakout trade? Better to enter on follow through bar or on the breakout? Or is it just a trade-off swing probability? It's the trade-off. So if you're entering a triangle breakout. Say, here's a triangle, here's a triangle. This is kind of a triangle. If you're entering on a triangle, then the problem you face is it is a tight trading range. So here's a good example of a triangle. And at this point, what's the probability, up or down? Well, you could say it's going down, I'm going to sell, and then I'm going to buy because it's going up, and then I'm going to sell. You'd be right on the third one, but you take two decent losses on the first. Most traders, I would just wait for a strong breakout with follow through. That's the first piece. And the other issue is, just like over here, if you're selling closes on this kind of a breakout and then you see the traders get trapped, the odds favor the market letting those traders out down here. And that was the problem here, is sell off, pull back, sell off more. Traders were getting trapped consistently, constantly betting on breakouts, but then being allowed out of the trade. So last question, is bar 44 a good buy signal? Try and with a lot of questions about good buy signals and sell signals in one answer or one question, it kind of makes it confusing. So try to shorten the question. But is the inside bar 44 a good buy signal? I mean, there's merit to it. I don't like it because it's basically a micro channel and the report's not far away. But always in traders may exit, betting the market test up here. Is close to 59 a good sell signal? Yeah, it's reasonable. These traders got trapped, and a lot of bulls that bought for any reason would probably get out here, betting the market go a little bit lower. So it's a surprise, strong enough surprise for going, and it will go a little bit lower. Is 70 a good sell signal? Well, it depends. You can take it, betting it's a double top and a bear breakout below a bull flag here, and a measure move down, which the bears got. So it's reasonable, but it's doji. So more often than not, you lose. Bar 72 is an inside bar. Is it a good sell signal? Yeah, I think that it's 2 legs down. Bears got a breakout, then they got follow through, and bulls gave up below the bar. Bar 80, outside up bar, is it a good sell signal? I wouldn't, I think 80 is just too late in the day. So, all right, looks like that is it for questions for tomorrow. Overall, we're in a tight trading range, so 60-minute chart, we're in breakout mode, as you can see on the daily chart. The bulls want high, higher low, and they want an upside breakout. Bears, they want the downside breakout. So this is a triangle. Better to just wait for the breakout up or down. All right. Hope everyone has a good evening.